Hello, this is Andrew, and I'm going to talk to you about, in my opinion, and take it with a grain of salt because you're going to need to do your own homework, really, and talk to your own financial advisor, for what works for you. But personally, what I believe in is the idea of buying dividend stocks, and then the dividend stocks that you try to make not a concentration of them, you try to diversify them, and you'll find that most of the dividend or the let's say the in again my opinion and check with your own financial advisor, the better dividend stocks are based on either REITs or BDCs, which are business development companies. But I think that there's a little bit more risk with the BDCs. There's also interest rate risk with both of these that you need to be cognizant about, and also talk about other risks. I don't talk about all the good stuff. I always try to give you the reality, because investing is risk, and you have to make sure that it's applicable to yourselves and do your own homework. But there's risks with closed-end funds that offer some crazy, double-digit returns, but it's a lot of risk. Or there's also ETFs. But I'm going to run through the ones that I believe in, and again, just take it as a personal opinion, and then I'm going to teach you some things. Okay. First one is Realty Income. That it's been around since 1994, 15.3 compounded annual rate of return. Pretty awesome, basically. And you can look here. I mean, you can look at FinViz. It's real easy to flip through these things. I mean, this zigzagging pattern after had this devastation in the COVID, but you're getting 4.6% on your money. That's a lot of money, and it's also with a company that's been around a hell of a long time. What Something to consider? Don't just look at the dailies or the weeklies. Look at the monthlies. Let's get rid of that. We don't need an ad. And you can see how it had this massive turn. But I mean, if you look on average, if you go back almost these years, you're almost at this median point. But one thing you might want to consider when you're doing any ETF, use very long-term moving averages. It could be a 100-day moving average, a 200-day moving average, that if you're above it, you're in the market. If you go below it, you're out. Simple kind of ideas. So that's my first one, is Realty Income. Next one is AGNC Investment. It's also another REIT, and they do mortgages. And it's more risk. It's also, like I just said, it has interest rate risk. So they're at 8.85%. Any of these, what I suggest you do is you go to their website, you read their website, and learn about them. Talk to your investment advisor to try to learn more. This one's been around since 2008. Okay? Next one, which everybody knows, which probably not everyone's going to love, it's Altera, which has also a very, very strong, and let's put these on the monthly again. If you just bought it and forgot about it, you'd be down 50%. That's why I'm talking about the idea of using some long-term moving averages. But Altera is another 8%. You might also want to do a crossover. You get 8% of your money, and you have the capital appreciation. It becomes another very interesting idea to add to your portfolio. And again, go to their website. Very simple. Click, and you read about them. People, I mean, I don't think people are going to stop smoking. But again, these are your decisions. Let me give you another one that I think is of interest. It's called Gain, which is Gladstone. Let's go to the monthly again. Okay, bingo. You also had this long period of just nothing happening, which is fine. That's what you like. And this one, Gain, you're 7.2% on your money. Go to their website, read about them, read about their financials. Okay? They're basically one of these business development companies. And you look at their portfolio. You can look at the diversification. Okay? So another one that we can do, which everybody knows, is AT&T. AT&T, you can also say it's a value play now, from 43 down to 28. Again, to reiterate the point of putting on long-term moving averages. Like right now, you're at prices almost from 2011. And the yield here is 7.23%. You go here, you read their website. You can also go to Yahoo Finance, read about their financials, look at their debt. things of that nature. Let me give you another one that I think is a little bit interesting. Let's get rid of some of these. Let's go to SJR, which is Shaw Communications. Another interesting point. Here you are, 27. It's a value play. You're getting paid to wait and 5.24%. But you have to do your homework. Don't just look at this and say, boom, I'm going to buy this for 5.4%. You look at the financials. You can look at the ratios, look at the debt levels. You can look at a lot of issues. You can look at price to book. You look at your book value per share, the dividends. I mean, what's sometimes interesting is some of these shares also get below book value, which also gets interesting. Let's look at another one. Oh, we did this one. Gladstone. No, we didn't. Gladstone Commercial REIT. Okay. Look how solid this is from 2011. It hasn't varied that much. Yeah, it had a little bit of a scare, but look at this. Look, it went down to 8, and the book value is here. Very interesting. Getting $1.50 on $8 was a really interesting time to buy, and has an 8.06% dividend. But again, look at the financials. Look at Yahoo Financials. Go to their website. Have a look at it. Another one you can consider is, I'm probably saying it wrong, it's PBA, Pembina, I think it's called. It's a pipeline. This also had some big drawdown from 28 down to here, but it throws off a very high dividend. 5.24, I don't know why that didn't come up. 1 second, PBA. Yeah, that's why. It had a very big drop, but then you had all the stability, and then another big drop. You look at the book value of 17, and you're a little bit higher, but here, these days, during this crisis, you'd be buying it at book value. So it's another idea of a diversification. One more I'm going to share with you is Main, which is Main Street Capital. And they're an asset company. You can also see they got whacked. That's why, again, you want to put on moving averages, long-term moving averages. Because you don't want to go from 45 down to 15. But when it gets down to value here, you should lighten up and learn about it and say, wow, what's going on here? Because what's interesting, like I'm saying about the book value, is 21.53. Imagine you bought it below book value or around book value, and you feel they were very solid with their debt to equity and everything else, and you're collecting a nice coupon of 7.3%. So let me just make a summation here. Do not concentrate just into one, like REITs or BDCs, or diversify yourself. Talk to your investment advisor. I'm not an investment advisor. I'm a private investor. I've been investing since 1994. I hope that this video was educational to you, and if it is, like it, subscribe to my channel, and don't buy stocks for the dividend. Do your homework and research the companies. So I hope this helps you. If you have any questions, I'll try my best to help you. Thank you.